Welcome, everybody. Happy Wednesday. Thank you for joining Chris and I today on this webinar. We wanted to do something a little bit different and talk about Chris and I's backstory. Who are we? Why should you listen to us? Why do we feel like we have the, knowledge to speak on what we speak on month after month? And why are we doing what we're doing? They kind of go hand in hand, as you'll learn. And so, Chris, kind of perfect timing. So we're going to talk about who we are, CWS, Chris, myself, our backstories, the team, our mission, and kind of how it came together and what we do specifically, where we've been, and where we're going. Now, we do have several other webinars, and I will refer to these webinars probably throughout this webinar, where we go into a deep dive on very specific aspects of what we do, whether it's due diligence or how we make money investing in mortgage notes or partnerships. So you can always refer back to those. This is going to be really more about our mission, what drove us to create CWS, and the opportunity that we have at a higher level. So with that being said, some additional notes that I've mentioned a few times for people who joined a little bit early. Please, one of the things we pride ourselves on is transparency and communication. So if you do have questions, feel free to drop them in the Q&A and we will answer them either throughout or at the end when we open it up for Q&A. So again, thank you for joining us and we'll get started. So Chris, you want to take this one?
Sure. So
I've stolen the word vomited everywhere.
No problem. So a little bit, about who we are and what we do. So a lot of people know us as 70 Investments or 70, that's our brand. Similar to like Google is owned by Alphabet. 70 is our brand, and our latest offering is CWS Investments, which is a C corporation where we buy performing and non-performing mortgage notes. And we'll, again, throughout this webinar, talk more about what that means and also talk about our team and investing. But really what we want to talk about today, like Lauren mentioned, is that backstory of how do we get involved in note investing. And we'll talk a little bit about, again, what it is. But today we're really focused on talking about how we came to creating CWS and 70.
So Chris and I's backstory is similar, but same, but different. So I'll go ahead and talk a little bit about me, where I come from, and how I stumbled upon mortgage notes. And so I'm from California, grew up here, went to university, and grew up around real estate. And I always say, make this joke, and if you're the oldest of three kids, and especially the oldest daughter, you totally get it. I grew up around real estate, but I wanted to do everything except for real estate. I wanted to make my own brand, build my own way. And I did that. I went out and I worked in software sales for just under a decade. Very stereotypical, probably what you see on TV, California startup. And what I realized along the way is, I'd always heard that buzzword, passive income, subsidizing your lifestyle, passive income is what you need, and what I realized is even as I moved away from technology into consulting for startups, and I thought, wow, this is amazing. I have so much more time and control of my time. I was still trading time for money. And so I started delving into probably doing what you're doing right now, attending webinars, researching bigger pockets, seeing who was posting about real estate on LinkedIn. And I started picking people's brains, meeting with people for coffee conversations. And we'll get to how Chris and I met a little bit later about that, and stumbled across mortgage notes. And I had never heard of it, probably like you, thinking, what are mortgage notes? And I decided that it was the benefit of owning real estate or having investment secured by real estate without being the landlord. So essentially you get to become the bank. Went down that path on my own, used my own capital to invest and build a portfolio of mortgage notes. And that's kind of how I met Chris, who had been in the industry longer than me. And I actually heard him speaking at a conference, and it was a virtual conference at the time. And his webinar was all about the ways you were going to lose money making in mortgage note investing. I was like, oh, who is this guy telling me like all the ways that I'm going to lose money? I want to know, because that's one of my criteria when I decide to go down a certain avenue is, what are the ways I can lose money? I want to know every way this can go wrong. So me being me, reached out to Chris probably a million times, like, hey, can I pick your brain? Hey, can we grab coffee virtually? Hey, I'd love to hop on a call. And finally, he decided to hop on a Zoom with me. We formed a partnership, which led to us managing hundreds of deals together, and eventually launching CWS. So, I mean, that was pretty long, but I'll let Chris kind of talk about his backstory, and then we'll talk about why CWS.
So, and what's interesting, Lauren, is my backstory is the exact opposite of yours. So I was the youngest of three, not from a real estate family, but I got into real estate when I graduated college because I was a civil engineer and then decided I really don't want to design buildings for the rest of my life. So I started working in construction management. Fast forward 15 years of in that space, and I was working for a real estate developer, which is much more entrepreneurial. And he commented to me, he's like, what's your passive income? Like, what do you have for retirement? I'm like, my 401k, that's what they tell you all the time. And he laughed at me and he's like, oh, you're a 40-40-40 guy. And I'm like, what's that? He's like, you're going to work 40 years, 40 hours a week for 40% of your income, and you're never going to retire. So I started getting, doing more real estate on my own. And when I found mortgage notes about 8 years ago, I was actually pissed because I knew about private lending, but I didn't know there was this aspect of the business. Just like a lot of people watching this webinar might have heard it for the first time, or all these other, ways to, use a self-directed IRA or other methods that nobody teaches you. It was very insightful for me, and I just got a passion and a love for it. And like Lauren mentioned with our story, she had reached out, and so I give her credit for finding me, but I give her credit for bringing her on board for all these deals, because I was managing, like Lauren, I started with my own money, and then I started doing individual joint venture deals. And then we started managing these in funds, and then it became too burdensome where I needed help. And Lauren, right place, right time, right person, came on board, helped me manage this portfolio. And, many years later, we're sitting here today talking about note investing.
Yeah. So something we realized about as we were managing these funds, these joint ventures, was that a lot of people with the joint ventures, there were a lot of people that weren't, didn't have the accessibility. There wasn't a accessible option for them to invest passively if you weren't accredited. And it kind of dawned, and Chris, I'll let you kind of speak a little bit to kind of your passion behind it. For me, though, I came from a very recent place where I wasn't too long ago. I was in that category of people who didn't have the access to these alternative investment strategies where you could have passive income, whether it was like investing in a development deal or investing in an income fund, like excuse me, like in an income fund like ours. So my passion, as I saw more and more people that we were working with that we couldn't work with in these funds because they weren't accredited, was how can we make something that is typically reserved for institutional investors or ultra high net worth investors available and accessible to everybody. And this is where Chris comes in, because that was my question, but Chris really was like, well, Regulation A plus offering. And so that's how CWS, our Reg A plus offering, came to be, where our goal is to and we tried to think of another way to say this, but everyone knows what this means, so we went with it. Democratize investment opportunities. So where everyone has access to the same opportunities that a institutional, investor might have. So doing that while also providing win-win solutions for our borrowers. And Chris, I don't know if you have anything to add about kind of your passion behind our mission and our backstory, but.
Yeah, I mean, like you mentioned, when we were doing a lot of those individual deals or even started with the funds, there's a lot of people who wanted the access but didn't qualify. They didn't meet that accredited investor. And it was unfortunate because there's a lot of, people who were still making really good money and had decent savings, but they just couldn't get access. But the other component to it that we also, talk about is, we do have access for accredited investors, but it also doesn't have that super high minimum, like other funds where you have to have $250,000 to invest. And as an investor, people want to diversify and want that diversification, and putting, everything you have in that one basket, can sometimes make people extremely nervous or shy to want to invest in those offerings. So we wanted to, again,
Yeah.
open this up to everybody.
Yeah, I think that's a good point there, Chris, because even if someone is accredited, they may not have, dabbled in real estate investment options or alternative investments. So then to go and say, hey, you need a $50,000 minimum, that's a big leap for someone who's never invested outside of your typical, stocks, bonds, mutual funds. So by part of that accessibility is not only, providing accessibility and availability to everyone, but also making it a low barrier to entry. So good point. I'm glad that you brought that up.
And now we're going to talk about where we've been, talk a little bit more about what we do. And like Lauren mentioned, we have other webinars on that. And also we'll talk about where we're heading in 2024. So where we've been, as a company being 18 months old with CWS, last year, we bought over 50 assets. And since our inception, we bought over 150 assets. So we mention this because a lot of people think open-ended fund, oh, it's a blind pool or a blind fund. I don't know what I'm investing in. We have a significant portfolio of assets already under our belts. And as you can see, we've been in over 30 states and have $70 million of real estate under our control. And also, Lauren mentioned about that win-win situations. Our goal is to try and work with borrowers to get them to modify the loan, because that is actually the best win-win for them as well as us and our investors. So that's the asset side of things. Lauren, I'll let you talk a little bit more about the investor relations team and what we've done and where we're headed.
Yeah. So, excuse me. As I mentioned earlier, my two boys are sick, so it's lingering with me as well. So one thing, Chris, that I want to also mention is the numbers that you see here, that's about our most recent offering. So we didn't, just decide to get into this industry a year and a half ago. We've had 5 other offerings go full cycle prior to this. The numbers you're seeing here are specific to CWS. And I think that's important to clarify.
Yep.
Now, when it comes to the investor relations team, we launched this offering July 13th of 2022. And the first raised just under 10 million. And we have tripled that since in 2023, heading into 2024. We have some big goals as well. Not only do we want to impact over 1,000 investors. So you can see we have 500 plus investors right now and just about 21 million in capital raised. But our goal is also to impact more people. So some people might think, some other sponsors or people sitting on our side of the table might think you're absolutely insane. There's no way I'd want to deal with 1,500, 2,000 people. But honestly, our team, and I think this, goes to our team and how strong of a operations and communication kind of system that we have. It doesn't seem like we have 500 investors. We have a dedicated team on our IR side that is available and accessible to help investors through the entire process. So I think that's something that has led to my next point, which is 22% of investors have reinvested with us. And I think this kind of comes from twofold. It comes from people who might have 100K to invest, but want to start with, say, 5 or 10 to get to know us, to see what our reporting and communication looks like. And then there's people who invest a larger amount with us and then do so again because we built their trust. So I think that those things are important to highlight. And then again, within this fund, we have not missed a distribution to date. So, and any of our past funds as well, but I was specifically talking about this one.
And I'll just add to that, Lauren, like you mentioned, every person we talk to who we speak with a lot of other fund managers, when they say we have 500 investors, like, oh my God, how do you manage that? And like you mentioned, our investor relations team is in-house. So they are employees of the company, and we use technology wisely. We don't use technology just to use it and rely on it, to manage everything. We use it to make our jobs simpler, but we have that human component, that human touch, where any investor can pick up the phone and talk to Katie or Tony pretty much, during business hours. So just wanted to kind of add to that as well. Here is, we just wanted to show, like we mentioned earlier, this is not a blind pool. Our current portfolio, as of about a month ago, we had about 93 assets across 28 states. The interesting thing that we'll talk about, and we talk about this significantly on other webinars, so I'm not going to dive deep in it, is when you look at the loan balance compared to the asset value. We don't take on leverage as a fund, and the balance of the loan is significantly lower than that asset value. So if house prices slump, which I think a lot of people predict, we are primed and set up to have that not impact our portfolio because of the loan to value ratio of only 28%. Anything you want to add, Lauren?
Just that loan to value is super important, showing that it's, not that it's a risk adjusted plays that we're making here.
Yes. And one way I'll just add is why it's so low. We're not originating loans. Like somebody's not buying a house yesterday and we're taking that loan. These loans are all 10 plus years old, which kind of rolls into what is note investing, because we've been talking a little bit about it, but let's just really break it down in simple terms. And Lauren's probably laughing when I say break it down in simple terms because I usually go on a tangent. But anybody who's ever bought a house, you typically get a mortgage and you sign another document called the note, which is IOU. And mortgage note investing is, banks sell those loans and they usually sell them to other banks or hedge funds. We are a fund that buys those loans. So if you've ever had a letter in the mail say, hey, mail your payments now to this address, your loan was sold. More than 50% of people's mortgages get sold. Now, what we focus on, which we'll talk about a little later, is kind of the types of loans that we do buy. But that is really note investing. Breaking it down in simple terms is you buy a house, you sign a mortgage, that gets sold, and at the end we will buy that loan, and then we have the right to collect all those payments. Lauren?
Yeah, you stole what I was gonna say, which is like my go-to, is, have you ever received that letter in the mail? I know when we bought our first home, I remember getting a letter. I don't remember who our bank was at the time or who owned the loan, but I remember getting a letter saying your loan has been sold, like to say Bank of America. Your payments now need to go here, and me being like, wait, what does that mean? Does this impact me? How does this work? And then here we are, full cycle investing in those notes. So.
So, like we mentioned, there are two types of loans. There's performing and non-performing. Mm-hmm. Performing is when a borrower makes their payments. I have a mortgage. I am my loan is performing. We pay our mortgage every month. The loans we focus on primarily are those non-performing loans, which are when the borrower falls 90 plus days behind. And when that happens, and we talk about it again on other webinars, banks will look to sell those loans at a significant discount. And the one thing I'll just add to that when we're looking at non-performing loans, to give people an idea, the average delinquency of a loan in our portfolio is about 3 years. So most people think, oh my God, I miss a payment, I'm going to have somebody come, put handcuffs on me and drag me out of my house. That's not the case. It takes a significant period of time to go through, the legal process if you had to go down that road.
I'll let you
take. You are primed and the expert at this one. I don't even want to touch this one because you do it so well.
Oh gosh, no pressure. So, this is the common question we get. Well, how do you make money? Like we mentioned, the concept I like to refer to is we fix and flip mortgage notes. We're buying loans on single family homes at a discount. For us specifically, we focus on our buy box, which would be first position performing and non-performing loans that are secured by single family homes throughout the US. So we're buying these loans at a discount, and we can talk about why they're sold at a discount here shortly. Then there's really two options that we can take. And typically about 80%, 90%, of our notes fall into the top category. So negotiating a payment schedule with the borrower. So as you can imagine, right now, there's not a lot of housing inventory. There's rent rates are way up. So borrowers are really incentivized to figure out a way to get back on track with their loan. And so again, over 90% of our loans fall into the top bucket, which from there, what we'll do is we'll work out a trial payment plan, we'll do a forbearance and maybe modify the loan. Then we season the loan, all while generating these profits. And when I say season, to take it from what's considered non-performing to be qualified as performing takes anywhere from 6 to 12 months. And so we season the loan all while we're collecting and generating profits from their payments that they're making. And then once it's performing, we have a few options. We can sell it back on the secondary market at a higher margin than we bought it, or the borrower will sell the property or refinance. So those are some of the exit strategies there. One thing I love about notes is you can be super creative. There is not one, this is the exit strategy we need to take. We have the flexibility because we're buying these notes at a discount, really to get creative with borrowers and make it work. The second, and this is taking ownership of the home. So this is really once we've come to the table and tried to get the borrower to work with us, if they say no, or if the property was, if the borrower deceased and the family doesn't want the property, taking ownership of the home, generating profits from the sale of the property, or if we don't take it back, from someone else buying it. And that's the second way that we make money in note investing. And there's so much more that goes into that as far as like the individual pieces that line up. So again, we have other webinars on our website that you can check out that really go deep into this aspect of it, including our due diligence process.
And I see some Q&As come through, Lauren. I'm afraid to click on it because I'll screw up probably my entire screen. So
yeah, I'll get to those in a second.
Okay. So I'll let you talk about where we're going because you briefly touched base upon it a few slides ago. But I think this is, important for people to understand, what our goal and what our plans are.
So like I mentioned earlier, our goal this year is to, one of our goals is to impact over 1,000 investors by providing them an passive income alternative and investment option with our income product. So that is, one of the higher level goals, but let's talk a little bit more about our portfolio. I know, Chris, that you can speak to that a little bit more.
Yeah, so like we talked about earlier, one of the things we're looking for people is an alternative investment. And for us to provide those monthly distributions, our strategy is to first get no leverage. We do not take on leverage. So what does that mean? We don't have a bank giving us money to go buy loans like you see in other types of real estate asset classes. If people are going to buy a multifamily building, they might have 70% leverage and 30% investor money. That is not our style or approach, so we have zero leverage. Next is that low LTV, which means loan to value that we talked about with buying loans that are 10, 15, 20 years old, because what happens over time with a mortgage? Mortgage is paid down, properties appreciate. So when you first buy a house, that loan to value is at its highest. But as time goes on, typically in real estate, prices go up, that value comes down to maintain that loan to value. Why is that important? Because, it shows our portfolio is not correlated to things like interest rate risk or property value risk, which is things that concern everybody right now, especially people who have invested over the last few years in other types of offerings. Anything else you want to add about the portfolio, Lauren?
No. So this is something that we focus on a lot during our due diligence process and bidding process, is making sure that the loans that we are purchasing are secured by properties that have significant equity. So this is important because we're buying them on the secondary market, making sure that there's significant equity so that in case of a market correction or housing price dip, that our assets are still covered. So buying them further at a discount only creates a further spread on the collateral and the loan to value. We call it the investment to value.
The other thing I just want to mention too, Lauren, is our portfolio, it's secured by real estate. We're not loans about to cars, credit card debt, student loans, any of that. We are strictly focused on real estate, and our primary focus is on that single family residential product. Okay, so let's talk a little bit about how passive, the accessible passive income fund, which I'll let you talk a little bit about this one, Lauren.
Yeah. So, this is something I think where a lot of people who are looking to get started investing start out, what investment vehicle do I use? There's all these options. And especially today with, technology and social media, I'm sure you're getting bombarded with options even beyond this on how to invest your money. So where do you start? Who do you trust? And what information should you be looking for?
And with all of this, a lot of people also just fall into that analysis paralysis
Yep.
component.
So, our specific fund is for people who are looking for the possibility of passive income, but are unsure of where to begin. They're looking for an alternative to the stock market. They're interested in real estate, but not necessarily sure if they want to own it directly. So there's always this misconception that owning a rental is a very passive income option, which I can assure you it is not. So, it's also people who are interested in wanting to invest in real estate, but no, they do not want to be a landlord or deal with any of that.
And the other is, you might consider real estate, but you just don't want one asset. You don't want one self-storage, one multifamily, because again, all those eggs are on one basket. With us, it's a diverse fund of, you've seen, 90 plus assets that are spread across the portfolio.
So that's where the Regulation A comes in. This is the fund that we were talking about earlier that is open to accredited and non-accredited investors. There is a 4-year hold with a minimum investment of $5,000, although we do offer some bonus incentive and bonus shares at $25,000. And we aim for an 8% annual dividend paid monthly. And something here that's important to know, and someone asked about this someone who's obviously been following us for a while asked about this in the Q&A, the tax alpha that there might be because we are distributing dividends rather than interest. So because we are a C Corp, you're buying into shares of CWS at a minimum of 5,000, you are issued shares, and those shares you're getting paid a dividend on. So when it comes time for tax season, you might be thinking, oh no, not the dreaded K1. But we actually don't issue K1s. For tax purposes, you would actually receive a 1099 dividend form, which is different than a 1099 interest form, which is taxed at ordinary income. 1099 dividend, these are considered qualified dividends. Now, total disclaimer, I am not a CPA. I don't know everyone's specific tax situation. So always consult with your CPA when investing and what the tax ramifications might be for you. However, long-term qualified dividends, are taxed as long-term capital gains, which is lower than ordinary income. And that lower, I will not even put a number out there because it really just depends on what your ordinary income tax bracket is.
The other thing I'll mention about the structure is also for people who invest with an IRA. Like, we do not take on the leverage, which we mentioned, so you don't have to worry about, again, Lauren and I are not tax professionals, but the UDFI or UBIT offering as well, where if an offering takes in leverage, a portion of whatever you make gets taxed because of that leverage. Being that C corporation kind of protects those IRA investors from that, but of course, always speak to your custodian with your IRA.
Yeah. And one more thing that I think is important to mention, you don't need to go back to that slide,
Okay.
but it's about leverage. So the leverage is really important to understand right now. And Chris and I could probably do a whole webinar on the capital stack. Maybe we should. But Chris, why don't you tell me, because I think this is something I didn't understand when I was new to investing in, alternative assets and funds, so to speak. Why today, more than ever, is it important to ask a sponsor or someone that you're thinking, also known as someone you're thinking of investing in who runs a fund, where, if they take on leverage, where they fall in the capital stack? Like, why are those questions important? And what is the capital stack?
Yeah.
We're kind of going off tangent, but this is something that I think is so important for people to understand as they evaluate different offerings?
Yep. So capital stack of, think of it as like a cake with different layers. And, when you invest in any type of fund or real estate asset, and you acquire it, typically the first person that would get paid is the bank or whoever has that leverage. Now, what's happened where you're hearing a lot about in the news is, especially in commercial, they're underwater, or because they have that interest rate risk, they have an adjustable rate. And, so they are who gets paid first. And then above that would be, other loans, but then there's a thing called preferred equity and then common equity. Now, when you look at that order of priority of loans get paid first, then preferred equity, then common equity, within CWS, we don't have that leverage. So investors who buy shares get that preferred equity, meaning they are, on capital stack, you want to be at the bottom, which means, you're in first.
Safer.
Yeah, it's safer.
You're not jumping. If things
yeah.
go south, you're not sitting at the top of the Empire State Building.
Yeah,
You're on the first floor. You can run out.
Exactly. Great analogy there, Lauren. You should have talked about this one.
I'm a visual learner.
Yeah. So that's why, it is important to understand that capital stack, because where it plays into account is the risk profile. Someone could offer an investor, hey, I think we can get 18%. But if you're like fifth in the capital stack, that's a pretty risky investment. Well, for me, I would consider that pretty risky investment. Everyone has to judge their own risk. So that's where it comes very important to understand where you fall into that category to measure that risk, because there's all different types of offerings that are out there with different types of capital stacks. And you want to understand, okay, where does leverage play in? How much leverage? And making sure that, people all of a sudden don't sandwich additional layers in between that capital stack that push you higher up that building.
Sorry, again, we kind of went off tangent, but very important that whether you're investing with 70 or another offering, that's probably my question I would ask right now of any sponsor is, do you take on any additional debt outside the capital you raise for investors? Yeah. Where do I fall?
And what type of debt is it? Is it adjustable or fixed? Because, a lot of people took adjustable 4 years ago, which that risk profile is a very different profile than it is, of course, today, based on where interest rates have headed. So, why a mortgage note fund? You talked previously, Lauren, about that passive cash flow, without the headache. And we like to joke, there's no termites, toilets, or tenants. Yes. Got the third T there. But also, how we touched the base on is really that profitability in varying market conditions, because we are not correlated to the stock market. Our portfolio really isn't correlated. It's not correlated to interest rates. We buy off of a yield. So I'll let you do an example later about talking about that. And then also, again, that pricing, where we have such a low loan to value that doesn't have a significant impact. So not being correlated with other asset classes is, great for a diverse portfolio. To tag on to that is you're also backed by collateral. It's backed by real estate. This isn't a Bitcoin fund. So it's, backed by, collateral, which is real estate. And also, again, we'll go back to that versatility that you mentioned with those multiple exit strategies that we could just talk about. Like you said, they can refinance, they can sell the property, we can sell the loan. And then even if we take it back, we can sell it to an investor, and we can sell it to an investor and seller finance it for a short period of time to them, or just sell it to the open market. The one thing we don't do as part of our portfolio that I'll just mention, because I know people ask this, is if we do ever take a property back, we don't fix it up to renovate it, because that's not really our business plan or our line of work. Anything you want to add, Lauren?
And you mentioned it, that we're not correlated to interest rates, or really not the stock market at all, but interest rates, for example. We get this question a lot. Well, interest rates were 3%. Now they're, 7+. How does, sorry, a question just came in. It kind of threw me off. So, how does that affect you? Does it affect you? And I'll give this example. So like Chris said, we bid based off of a specific yield we're looking to get. So if we're looking for a 12% yield, and Chris has heard this analogy like a million times, but it's like the most digestible. And so if you were looking for a 12% yield and we see a note that's come across our desk for bidding that was written at 3%, we're going to need a 75% discount to make those numbers work. Now, will the buyer say, yeah, that works for me? I don't know, but maybe, maybe not. But what our bid is based off of what we need in order to get that 12%. Now, if we have a loan that comes across our desk at 6% interest rate, we'll need a 50% discount. So again, our bid is really adjusted based off of interest rate and there's no direct, I guess you could say, correlation there.
And kind of like what we mentioned previously, we're not originating loans. So it's not like 2 years ago, we originated loans at 3% like Silicon Valley Bank was. Now today's market's at 6%. So they would have to sell those at a significant loss. Again, we're buying loans that have, significant what's called seasoning, or they're older loans.
So why invest? So I want to talk about our multifaceted approach to our portfolio management. And just like Chris mentioned, having the investor relations team in-house, our asset management team is also in-house, which is very important for efficiency, how quickly we can fix and flip notes, all the things. We're not outsourcing this to a third-party company, which is why there is no additional management fees, because we are keeping this all in-house. We're not paying someone else to manage this. So we purchase notes at a steep discount, like we mentioned earlier, anywhere from 40 to 60% discount of market value, which gives us that flexibility to really restructure and work with the borrower. We are extremely selective. So this asset class, it's a $16 trillion industry. So we can afford to be extremely choosy with the notes we take on. Just to give everyone an example, in Q1, we probably saw about 300 million in loans come across our desks for looking for bids. Q2 was about 300 million a month. Q3 and Q4, about 300 million a week we were looking at. So the market has really, I guess you could say, inventory is way up, which is great because that allows us to be choosier on the notes we acquire and also get better pricing. We also diversify. So we're looking at, the local economic conditions can really drive local real estate markets. We don't have all of our assets in one area. Like you saw on our map of the portfolio earlier, we're really spread throughout the US to minimize risk. And then we work one-on-one with borrowers to get them back on track. So we're focusing individually, and this is really where the asset management team being in-house is so important, on working with the homeowners to design the right monthly payment commitments to pay off that mortgage note or get them reperforming. And again, because we are acquiring these notes at such a discount, we do have that flexibility to do so. Someone asked a question that kind of falls in line here. They said, if your team is not doing renovations, who do you sell a property to that you have foreclosed on? So kind of to go back to how we make money, that the foreclosure bucket is less than 5% of our portfolio. And then even if they do go to foreclosure, we might not be able to take them back because someone else, and as you can imagine right now, when housing prices are through the roof and interest rates are high, might go to the auction and buy that house all cash, because for them, it's a huge discount. So we don't typically take back a ton of properties. And if we do, we have an REO company that helps us with the liquidation of that asset. So
yeah, one thing I'll just add to that, Lauren, is we talked about that loan to value of if it's a $500,000 property and $150,000 loan. If we go to foreclosure, we're bidding 150,000 because that's what we're owed, because we can only get paid the 150. If it sells for 500, we don't get the full 500,000. We only get what we're owed. So part of our strategy is, if it does go to foreclosure, 90% of the 10% that probably get foreclosed on actually get sold at auction, because investors will come pick them up at a discount. And like you mentioned, in today's economic environment, with housing such a low inventory, investors chomp at the bit when they see low initial bids on foreclosures coming down that pipeline.
So how can we help? Why do we put on this webinar? One, again, we really do want to impact over 1,000 investors this year. And a big part of that goes into educating around mortgage notes, passive investment options, and who we are as a company and as a team. So we really pride ourselves on our transparency, our customer service, and being accessible to our investors and potential investors. Other ways to kind of stay in touch with us, join our newsletter. We send out case studies every week about actual assets and I say projects, actual case studies of assets that we are working on or have worked through all the way. And that gives people a good idea of what we do and the different exit strategies. So I definitely join our newsletter. And then reach out with any questions. Like I said, we are available and accessible. You can reach us at invest@70investments.com. And if you're someone who's on LinkedIn, feel free to give myself or Chris a follow. We put out a ton of content on, the market, how it affects our asset class, interest rates. I also talk about my kids a lot. And lessons I've learned from a 5-year-old. But, again, we are here as a resource. If you're interested in learning more about our fund, feel free to reach out to us via email. Or join our newsletter and just be a fly on the wall and learn more about who we are and what we do. So I don't think there's any more slides. Are there, Chris?
No, just a thank you.
And then, so actually I think there are 2 disclosure slides.
Yes.
Disclaimer disclosure slides. So I'm not trying to rush over these, but if you want to go ahead, again, a couple of things, past performance is not indicative of future success. But we do have our disclaimers here. And again, this will be sent out for replay as well. So if you want to go back to the thank you slide. Oh, or this is good. Okay. So I want to answer some of the questions that came in. We got a lot of great ones and have about 15 minutes left. So we'll just kind of go until the end of the hour. So Chris, I'll kind of go in the order they came. How many of the loans purchased went into a negative profit? I understand as part of doing business, it is possible. Just want to know the metrics.
Yep. About 2 to 3% of loans go into negative. And I'll mention that we are consistently evaluating our portfolio and looking at each asset to determine what our exit strategy is. And again, looking at ways to mitigate the risk on those assets.
Yeah, I think that's important. The asset management team meets every other week or monthly to do this. And part of that is looking at assets that we may have acquired and knowing when it makes more sense to sell it earlier than hold on and try to continue working with the borrower or go through the foreclosure process. So like I mentioned earlier, there is that creativity with exit strategies, but also the due diligence and I guess not due diligence, the diligence we have on constantly evaluating all of our assets.
And I'll just add, when we talk about like a negative profit, usually that percentage is extremely low in regards to any type of loss that we take on those assets. So I just wanted to kind of mention that as well.
Preferred dividend is 8%, average or fixed. Are there any other fees? Is the offering for your minimum or for your term? Oh, this is a great question. I get this all the time, which now makes me think we should do a frequently asked questions webinar. So it is a fixed 8%. I hesitate to say fixed in this industry because that implies guarantee, but it is not fluctuating. So it's 8% annually, paid monthly, which I also don't know if we mentioned. It is paid monthly, and it is a 4-year offering minimum. At the end of 4 years, think of it as you are an at-will investor. You can choose to redeem your capital right at 4 years. You can continue to accrue the 8%. You can redeem some of it. You can, So it doesn't lock up for another 4-year term. That's a great question. Will you send a recording of this webinar? Yes, we will send a recording of this webinar to all those who registered and could not attend, and those who registered as well. We'll have it, as well as it will be posted on our website for anyone who wants to go check out some of our other webinars as well. How do you decide how much of profits gets paid out in dividends? How do you make money for the company? That's a great question. Go ahead, Chris.
Yep. So that is a great question. As you mentioned, we don't collect management fees. So Lauren and I are employees of the company. So we do collect a salary, but we don't get any upside until after the investors receive all of their full distributions. So it's not like we're collecting a 3% management fee, an acquisition fee, disposition fee, selling fee, servicing fee, and every other fee that could be in there. We get paid a salary, like I mentioned, and the upside, like we mentioned, Lauren and I have the common equity in the company, but that doesn't kick in until every investor achieves the returns that were provided to them.
Is my investment placed on an individual asset or the full fund? So that's a good question as well. The investment is on the entire portfolio, which really mitigates risk because you're not tied to the outcome of one asset. So you're tied to the outcome of the portfolio as a whole.
See a question of the financials in the public offering, go through 2022. So we are in the process of going through closing the 2023. We're going through the audit with our auditor is Grant Thornton. You probably heard of them. I think they're like number 6 in auditing firms in the country. So we're working through that process right now, and updated financials will be submitted, I believe, by April 30th, I believe.
Yeah,
we have,
end of April.
Yep,
Yeah,
120
so
days to submit our audited financials.
how liquid is our investment in 7E?
I was gonna say it's a liquid. I mean, it is a, we
4-year
can't.
hold.
Yeah, there are penalties if you do wish to redeem early, but it is an illiquid investment, which for me I prefer. So I'm not always changing like stocks and so forth and always picking the wrong one.
Do you plan to offer a product with a shorter hold period? You mentioned a 4-year hold period on the main product. Does the firm plan to offer a 6 or 12-month type of product? Not at this time. You don't know Chris very well, but I will tell you, maybe you do, maybe you've watched a ton of webinars, but nothing is ever done without a lot of planning and strategy behind it and a lot of Excel spreadsheets. So all of our previous funds, we really did kind of offer different terms, different returns, different, some were split, some were pure preferred return, some were 1 year, some were 3-year. And we really did that to find what was the best suited for this asset class to provide a win for borrowers, for investors and the company alike. And that's kind of how we landed on a 4-year hold. So not at this time, but you never know.
And I'll dive in a little bit more into that too, Lauren, is when people look at 6 or 12 months on the non-performing side, it takes 18 plus months usually to work out a loan and go through that full process. So think about if you were going to buy a house that needs to be renovated, that's going to take you 18 months, and you were trying to sell it after 6 months. The maximum value isn't there at that period of time. So to maximize the value of the product we're offering to investors, like you said, I've done a little bit of analysis on this with our prior funds and kind of structured it to meet those demands.
2 questions asked about can we get more than 8%? It's 8% annually paid monthly. Is there a possibility to upside beyond 8%? So with our Regulation A+ offering, we do offer bonus shares. So I don't know, Chris, if you want to talk about how bonus shares work, but high level, we have different bonus share tiers where you invest, for example, I guess I'm going to answer this. Sorry, I just kept going. For example, our first bonus share tier is $25,000. So if you invest $25,000, we are awarding you an additional 100 bonus shares, which equates to an additional $1,000. So you're going to earn 8% on $26,000, even though you've only invested $25,000. And then at the end of the 4-year term, you can also redeem that extra $1,000 that you were awarded. So that tier, bonus share tiers, there's a few of them. 25,000 is the first tier, 50,000 is the second tier, 100,000 and 250,000. So if that's something that you're interested in learning more about, again, feel free to reach out to our Invest at 70 Investments team, hop on a call with one of them. If you're like, can you send me a screenshot of what this would look like, or an investment overview of what this would look like if I was to invest X amount.
And Dave asked a similar question. What's the expected return on individual investment after that 4-year term? like I said, it starts at that 8% annualized and can go up over 10% based on the investment amount.
I think I just answered this, but someone asked about the incentives for larger investment. And that is where I will refer back to bonus shares. If I add more money to my current investment, is that investment held for 4 years, or does it run concurrent with my original investment? Oh, this is a great question for 2 reasons. So every investment you make has its own 4-year lock. So if you invested today or January 1st, that would, for 5,000, that would $5,000 would have its own 4-year lockup if from something you say invested on February 1st. So it's not cumulative in the same way that if you invest 5,000 today and 20,000 on February 1st, you don't become eligible for those bonus shares. It has to be in a singular investment to qualify for bonus shares.
I'll steal kind of your role a little bit here, Lauren. And with that process that Lauren mentioned, if you invest today, the money goes into an escrow account, and then a transfer agent actually issues the shares. So they are dated based off of the investment, which the investments now in escrow would close on February 1st. So you would start accruing that dividend on February 1st. And then March 1st is when your first distribution payment would be made. And then, like you said, if you made another payment on, February 28th, that then would kick into that next cycle.
Yeah. So a lot of people ask, and this is something that I, again, didn't know when I was new to investing and looking at alternative investments, is how quickly am I paid on the money I'm invested? Because some offerings, you might not get paid till the end, till the property is liquidated. You might receive a quarterly payment or an annual payment. Ours is monthly, and you're paid within 2 months, depending on at what point in the month you invest. So like Chris said, you invest in January, your interest starts accruing in February, you're paid in March.
And Brad has a good question. The dividends, when they're paid out, they're issued to you. It's not a reinvestment. It is paid out to you. So we ACH you or mail you a check, however that process is. Once you get that dividend, it's like getting a check in the mail. You're free to use that however you want. And I'll also add to that, sorry, Lauren, that we've never done a capital call or ever see a need to do any type of capital call within the fund, again, because we don't have any leverage.
And for those who might not know, can you elaborate on a capital call, but we could be here all day if we keep going down. Maybe this is, again, another webinar. So one thing I want to also mention there is, yes, it is an income play. The goal is, or part of the mission as well, was to give people that passive income, or the aim to provide that passive income, where we are they're investing and they're getting a check or an ACH to subsidize daycare, phone bills, car payments, groceries, whatever it might be, retirement, excuse me. So that really it is that income play. And as far as, how does that onboarding process work? What does that look like? This is where really I have nothing but amazing things, and so do a lot of our investors, have to say about our investor relations team, really getting investors their access to their investor portal, bank information into the secure portal and everything, so that distributions can be made on time.
Keaton asked a great question about, checks to your self-directed IRA custodian. Depending on the custodian, most of them accept the ACH. So we have direct relationships with the custodians, and most custodians, we have a rep that works specifically with our fund that we will send the money to them. They'll have your account information on it. So it would be, if it's Advanta, that's one that popped in my head, Advanta IRA for benefit of your name and account number. And then that would get ACH'd, and then a day, it'll hit their account, and then they'll put it in your account for you.
So, another question came in. After the 4-year hold period is over, what is the procedure to redeem? And is there any additional wait period until the money is returned? Great question. So at the end of the 4 years, you would request a redemption with us. We actually have a redemptions email that you could email, and we would start that redemption process, and we have up to 90 days to return funds. Typically, it's really just a matter of how quickly that a redemption is processed through our transfer agent redeeming the shares.
And there's paperwork you have to fill out. So it's a matter of how fast you get the paperwork to it.
Correct. So can a Roth IRA invest in 7E? So if that is held by a custodian that allows you to self-direct into alternative assets, yes. So some of those being Advanta, Equity, Quest, Directed Trust. So we have, if you don't have one of those, or if you're curious if yours qualifies, again, feel free to reach out to us, and we can let you know.
A question was asked: will we close the fund when we reach 8,000 investors? No. That's our goal for this year, is to get to 1,000 investors.
Another 1,000. So we have 500 plus now. We want another 1,000 on top of that.
Yes. Sorry.
But no, the answer is no. It would not be a closed-end fund. We got through all of those questions, and look, 10:30, or I guess 1:30.
We're getting good at this.
East Coasters. Is there a reinvest option that would make the dividend non-taxable? At this time, there is not a reinvest option.
If you did get a distribution large enough to reinvest, it would only be, I think, again, if it's a tax deferred account. Think about if you're buying like Apple stock, you get a dividend from them at the end of the year. You're free to do with it. If you go to reinvest that into Apple, there are, depending on the money you use, there could be tax consequences on that.
Awesome. Thank you guys all for joining us today, hearing our backstory, hearing our mission about what we're doing, looking to do. Like I said, if this piqued your interest, or is your first time joining us, please head over to our website, 70investments.com. Look at our webinars. And also, and one thing that we do, and I want, again, give some shout out to our operations and IR and marketing team, is investor feedback, or things that they would like to see more of. So the case studies that we send out weekly, that was a really big part of listening to you guys, as well as posting our past distributions on our website and posting the case studies on the website and our webinars. So we're here to educate, also raise capital for the fund, obviously, but we do take feedback and very seriously, and are trying to do the best we can. Anything to add?
I'm good. So, and I'm just going to say I apologize for my look today, not my usual camera, as I am down in Miami on a work trip that we're down here for. But just want to, again, thank you, Lauren, and thank everyone for hopping on today. And as you mentioned, we love to communicate with everybody and answer questions. So if anything comes up, please feel free to reach out. We're here for you.
Awesome. Thank you.
Thank you.